It's Monday, and it is time for FreightWaves Today. We have a full show today, maybe one of the fullest of shows. Full Bay will be here, the CEO of Full Bay. Going to talk about maintenance across the road. Trent Broberg, well, I've known Trent when he was at Truck Stop as an executive, is now over at Full Bay. Is going to give us the rundown of what they do to really help fleets manage their maintenance. And shops manage maintenance. We're going to get into the merger with BNSF. Zak Andersoe, who's the chief of staff, is going to talk about the UP-NS merger. I imagine he's got a different take than what we heard last week with UP and NS CEOs.
Yeah.
So different take, obviously a competitor. Brian Fialco is going to talk about safety. He's written a book that is going to really outline his whole thing about safety and what fleets and should be doing around safety, the importance of it, and how to think about it. And then we're going to get into really what does all this trial plaintiffs' attorneys cost on the economy, and why are attorneys? He wrote a great post on this. Is that it's actually the trial attorneys that are fighting autonomous trucks, driverless trucks, because they are, by every data point, safer than human drivers. They don't make human mistakes. They're not foolproof. But plaintiffs' attorneys have a vested interest in keeping the roads less safe, and they've been fighting this technology, which I think is somewhat ridiculous, and he's going to tell us all about it. So we're going to get into that. We have a heck of a show today, but let's get into the headlines, because I think so much to talk about.
We kick things off with a major statement from the truckload sector about where the pricing cycle is heading. Schneider National handily beat second quarter expectations and raised its full-year earnings outlook, declaring that a capacity-constrained truckload market is only in the early stages of rate recovery. The Green Bay-based carrier is using the favorable supply-demand imbalance to recoup multiple years of significant cost inflation, with its network fleet capturing double-digit rate increases on contract renewals during the quarter. Schneider reported adjusted earnings per share of 29 cents, 6 cents above consensus, and boosted its full-year adjusted EPS guidance to a range of 90 cents to $1.10, an 18% increase from its previous outlook. President and CEO Jim Filter said the positive impact of non-compliant capacity exiting the market has been realized more quickly than initially anticipated, and mini-bid activity is surging as shippers grow more concerned with securing capacity for peak season. Over in autonomous trucking, Aurora Innovation is spelling out exactly what its driverless technology will cost carriers. The Pittsburgh-based developer reported a second quarter net loss of $270 million on $2 million in revenue, and detailed the per-mile pricing behind the two business models it's selling to the market. Chief Financial Officer David Maday said Aurora's transportation-as-a-service offering carries a per-mile revenue outlook in the $2+ per mile dollars range, while its driver-as-a-service subscription targets 0.85+ per mile dollars. Under TAS, Aurora holds the DOT authority, controls the truck, and carries the insurance, while under DAAS, customers acquire and manage fleets directly while subscribing to the Aurora driver. Aurora said it is fully allocated to exit 2026 with 200 driverless trucks, which equates to roughly an $80 million annualized revenue run rate for the TAS business, and expects its second-generation hardware kit to cut Aurora driver hardware costs by more than 50%. Finally, the battle for enterprise artificial intelligence supremacy is shifting to an entirely new front. Yoav Nava, founder and CEO of Reindeer, told FreightWaves at the Supply Chain AI Symposium in Chicago that the market for enterprise AI agents is no longer being won on model quality. And that shift is fundamentally reordering where startups are planting their competitive bets. Nava said enterprises have burned through 2 waves of AI adoption without unlocking expected returns, and are now chasing a third wave targeting core operational workflows that represent 70% to 80% of the work inside companies. He argued that large language models are becoming a commodity, with open source models only about 6 months behind the frontier models, and that the real competitive edge now lies in the maintenance layer, detecting when a workflow drifts and adjusting the agent without a new engineering ticket. Nave said the expertise needed now is making sure that what was amazing on the first evening it was released is still amazing 6 months later.
So, Julie, I think, so much is happening. What is your take from the headlines?
Okay, so, really, Aurora, we'll talk more about AI later. I thought that was interesting. They 200 driverless trucks by the end of 2026. moving forward there. I thought the AI take on LLMs being a commodity and the real moat is the maintenance layer was interesting.
Which makes sense. I mean, at the end of the day, the cost of Claude comes down. These AI wrappers, if you will, these companies and startups that said, "Hey, we're an AI company," but ultimately Claude and other models are getting better. Why would you go through a third
And
party
open
wrapper?
source is always going to continue to catch up, right?
And the
So even
Chinese
if
have
you've
their
got
own
a
open
couple
source
of
models.
months,
Yeah.
then I absolutely agree. The maintenance and continuing for it to improve is the thing. But the Schneider earnings are what I thought was most interesting to talk about. And we'll talk about them a little bit with Todd, but here's sort of my take on the overall. 48% of their total revenue is truckload, right? So that's both dedicated and over the road. Dedicated and over the road truck counts were down. And I thought that was interesting. So
But
average
doesn't that match what we
normal.
talked
It's what
about?
we're
And
hearing
even
in
with
every
David
case.
Parker, he talked about truck count
Yep.
being down. We've heard this from a consistent, even Knight-Swift's truck count was down. I think a lot of these carriers are just, it's interesting because you guys had Dr. Jason Miller on, 2 weeks ago, 3 weeks ago? I was out, but he talked about how he thought the carriers always correct. And it's not what we're hearing. We had Mark Scudder on a couple months ago or 2 months ago, and we're hearing the opposite.
It's exactly where I was.
Fleets are not adding.
Yeah, they're working on margin improvement, profitability, and increasing utilization. So even though their truck count dedicated went down from 8518 to 8292, OTR went down from 3706 to 3470, same quarter last year compared to this year. But their operating income was still up 28% and their net revenue was up 1% year over year. So they're doing more with what they have.
Which is great. I mean, ultimately, we're in a business to make money. I mean, that's why these carriers exist, and they haven't had the opportunity to kind of maximize profitability. They're focused on maximizing profitability because this environment's allowing them to do it. We're going to get into that with Todd Maiden. He is our reporter. Anything else before we move to Todd?
Yeah, I mean, I think you can't talk about Schneider without talking about intermodal and then thinking about the giant intermodal.
The JB Hunt operations.
And it's huge, right? JB Hunt is massive.
We love the railroads here.
1.75 billion JB Hunt's intermodal versus Schneider's is 262 million. So
Much
I mean, hard to
smaller.
compare the two, much smaller. Their revenue was only up 1% in that segment, though, and in a 93 OR. So they're not seeing quite as much tailwinds there, it seems, as what we saw with JB Hunt.
Well, look, I think JB Hunt's contract, Max talked about it last week. I think he was asked if he could come back in another life or run a business, what he would pick. He wants to run an intermodal operation with JB Hunt's contract. Can't blame him. I still think the railroad is the better play. I kind of want to own the rails and charge JB Hunt for it. So I like that business model better. Plus, amazing historical patterns. So let's move to our next guest, Todd Maiden. He's a reporter for FreightWaves. Spent time on Wall Street and now has, for the last 7 years, has been at FreightWaves reporting on these public earnings. Todd, welcome to FreightWaves Today.
Thanks for having me. Good to see you, Craig, Julie.
Well, Todd, let's get into it. What is your general takes so far? We're not at the end of the earnings reports, but we're certainly 80% of the way through. What is the scorecard in terms of who's winning, who's losing? What have you been surprised by?
I think virtually everyone had truckload, less than truckload, really good results. And this was really the first, financially, the first quarter of likely many good quarters to come. And I think what is interesting is, the stock reactions were all almost to a company negative, some gapping down 15, 20% in the days following their reports. And a lot of it, I think the space is just priced for perfection. We may have ran too far too fast, but all of the companies, their stocks inflected right around Thanksgiving when we first had that positive move in tender rejection, spot rates, and they've continued to run up ahead of actual what the earnings will be probably next year and beyond. So we had a couple of big earnings beats, but not the broad-based blowouts that we were hoping for. And I think another overhang on the stocks heading into second quarter earnings season, Q2 earnings season coincides with the weakest part of the summer. So, I think kind of as spot market, as tender rejections, as everything kind of takes a breather, so have investors. And they're waiting to see what analysts do, what they build into EPS numbers this year and next. So I think they're just looking for a little bit more on earnings trajectory. But you mentioned winners and losers. I think it was if you dive through the numbers, mostly winners. I mean, obviously, J.B. Hunt, it's fourth quarter in a row of operational improvement, and that was all predicated on cost takeout and AI-led initiatives bleeding through to results. Knight Swift, probably their one-way unit, irregular route, probably the truckload carrier most exposed to really that leading edge of the truckload market. Schneider, great number you mentioned there. You guys talked about it a minute ago. And then on the LTL side, XPO, just continues to perform quarter after quarter.
XPO pulling in a 80 OR, I'm rounding a bit on that. I mean, it's pretty remarkable, but we've talked about this, we joked about this on Friday, is Old Dominion is XPO is probably super excited they got an 80 OR, and it's like the kid in class. When you get an A and that kid gets an A+ and just smokes you, that's how it feels with Old Dominion on this earnings. I mean, a 70 OR is absolutely pretty remarkable, Todd.
It is. So they matched their best ever EPS result, and they still don't have the demand inflection there. I mean, it's getting a little bit better around the edges. Some of that freight that was maybe lost to the truckload sector is coming back. Industrial economy, our PMI number, Institute for Supply Management's number out this morning was 7 straight, in positive territory. So that's really good. But that's really just starting to show up in weight per shipment on the LTL side. So what OD's done, that 70 OR, tied a record for EPS without really having demand kick in is pretty impressive.
So Todd, I think the sort of standouts in this, LTL guys did much better. You mentioned the fact that guidance volume hasn't been as robust. They're still getting significant operating improvements. But it feels like, I think the reason, this is my interpretation, is that Wall Street sold off because they were not only priced for perfection, but there was some questions about guidance. There was questions about how strong. They weren't particularly on the truckload side, they weren't as, I'd say, assertive or had as much conviction about continued recovery than maybe some of the LTL operations were. It felt like the LTL guys, at least from what I could gather, were more constructive about guidance than the truckload operators. Is this just because the truckload operators have set themselves up for failure in the past when they've talked about the cycle and cycle inflection?
Yeah, I think that's a great point. And I think that is really where we are now so we've had heightened regulation, enforcement, crackdowns on driver schools, ELDs, et cetera, you name it, a number of tailwinds for your big, large-scale operators. So I think investors are at the point where do we have to decide if TLs are rentable or ownable? And in the past, they've always been rentable. I think most investors have just traded around spot market inflections. But if the capacity drawdown, which is rooted in safety, and appears to be a bipartisan initiative, if that stays, bottom feeders are removed, maybe the industry isn't as fragmented as it once has been, then those valuation multiples have to move up. So I think all truckload carrier management teams are very constructive on what the cycle looks like, where they are in the cycle, early innings of double-digit year-over-year increases in one-way rates and steady rate increases on dedicated side. But we still have that separation where it's not into numbers yet. And part of it, and Julie, you talked about, Craig, you talked about, everyone has trimmed their fleet count just to sweat the assets better and to prove asset utilization. So demand quite isn't there yet, not adding tractors yet. So the numbers, we're not getting that explosive growth in numbers yet.
Yeah, it's funny, Julie, I was telling my son, Max, who's learning about the transports, is actually interning at a hedge fund with Seth, so he's going to be over there.
Nice.
But I explained to him about the truckload market. I said, these are the stocks that you date, you don't marry. And I think Todd's description of rent versus own is, I guess you could argue, is the same analogy. I had to speak in the word of a 19-year-old where you get it.
You're exactly right.
You know, you don't take them home to mom. They're a lot of fun when they're on the good side, but they can also ruin your life if you stay in there too long. So
Take them to a bar, not to a long
don't
dinner.
take them to the bar. You date them. You don't marry them. They're not the ones you marry. LTL, obviously railroads. We should all marry them and have children with them. So we all want to be in the railroads.
Right, and you're right in trucking. I mean, LTL, huge moats, high barriers to entry, highly consolidated. You know, the top 5 control 50% of the revenue. It's like the top 10 control over 70%, almost 3/4. So, you know, no one's showing up buying 200, 300 terminals, layering in all the tech, the operational expertise, the management team. I mean, it's just tough to replicate. So that's why we get quarter after quarter, year over year, mid-single digit contractual rate increases. I don't care what revenue per shipment's doing. I don't care what yield's doing, because that's just a calculation based on how heavy your shipments are. But I mean, such a highly defensible. You know, we're only a handful are true national carriers and control the market.
Todd, I got to ask this question, maybe because someone asked this of me, is Amazon's got its new LTL product that they've rolled out. Only 30 terminals, 300 is sort of to get a national coverage, you need to have at least 300 is sort of the benchmark. Why didn't Amazon bid on the yellow terminals that they were planning on rolling out a national LTL product?
Yeah, I think there's a lot of consternation around what Amazon's LTL will ultimately look like and what they're trying to accomplish. I don't know how big of a player they want to be. It doesn't, to me, their involvement in the space. I know they're totally a third-party supply chain. They want to have assets. They want to move freight for shippers. But I think competing directly with FedEx and UPS, that's a much larger TAM than less than truckload. I mean, it's like a $50, $60 billion market. It's not even a tenth of trucking. So I don't know what they ultimately want their competitive position and how interested they really are in the space. There were rumors a couple of years ago that they were looking at acquiring Old Dominion. A move like that, I don't think that's going to happen. But a move like that, if they wanted to get into the space, even if they're paying a premium for it, which they could afford to do, makes a lot more sense buying something that's already up, running, proven, when it's so difficult to enter the market. So I think there's still a lot of, they play their cards close to the vest. It's tough to say what they want to do with LTL. So I don't know how much of a distraction that's going to be, but you're right. I think one of the signals, the fact that they didn't get into the bidding for the 325 terminal yellow portfolio that hit the market, speaks maybe to what they ultimately end up doing. And I don't know how big of a player they'll end up being.
Yeah, that'll be interesting to watch, and it certainly would make sense for them to acquire someone, but they tend to build versus buy, so we'll see. But
one counter argument on that is that to run an LTL network, you need local drayage drivers or local P&D. You need line haul, and if you don't have the volume in LTL, it's hard to sort of jump into these big terminals.
Yeah.
That's my explanation for it. Whereas they tend to.
How do you create the utilization? Yeah.
No, I was just going to say you're absolutely right, and that's why Saia's shares were down almost 20% on the week. They put up a really good number. Their third quarter guide was a little light, but they've added just in the last couple of years over 60 terminals that are still running at like a low 90 OR when the rest of the organization's probably in that low 80 range. So, yeah. You're talking about 3-4-year-old terminals. It's still tough to ramp them to profitability for someone that's a proven entity in the space.
It's a same-store sales model.
30 of those are within the last year. Even so,
they
quite a few
have massive
even
expansion.
This year.
They're not getting any credit from Wall Street on it. And as Todd says, it's unfortunate because they should be credited with same-store sales growth. You wouldn't punish a retailer for building out a physical footprint. Why punish the LTLs?
I want to talk a little bit more about Saia too, right? So, because I feel like we haven't talked as much about their earnings as we have the ArcBest and Old Dominion, and probably need to talk a little bit more about XPO too. But they did show 17% revenue growth, They still had an 86.9 OR, which is better than what ArcBest showed. And as we mentioned, that was due to the newer terminals operating at the higher OR with the existing at the lower OR. And they were up on tonnage. I know you said yield and tonnage and shipments don't really matter, it's revenue, but I mean, up 4% on shipments and up 4% on weight per shipment. So it feels like things are moving in the right direction. Do you have more of a take on that?
I do. I mean, I think they had. Look, this was not the earnings season to have to explain yourself. They did have it was a 4% small EPS beat, 86.9 OR, was 90 bips better year over year. It's their first year over year margin improvement since the first quarter of 2024, but the shares are off almost 20%. I think I looked at it 3 reasons. I think the 3Q guide implies a small step back in margin, 30 bips down year over year. It's way too early in the cycle for that for investors. They're expecting everyone to this is the low hanging fruit time of the market, when the market inflects. But they did pull forward a wage increase, so they had 2 wage increases in the same calendar year. That's a headwind. And then they also pointed to revenue per shipment was up 4% sequentially through the quarter. That's positive. But then July tonnage moderated. Part of that was due to a general rate increase that they just implemented at the end of June, created some volatility in shipments during July. So I think there were just a few things there that investors didn't like. They got punished for it. Yield came in light, but they had some explainers there as well that I think all make sense. I think I think by the time we get to the fourth quarter, we get down the road a little bit, let them absorb some of these terminals and ramp them to what the rest of the network's doing. I think we blink and they're back to sub mid 80s and low 80s ORs.
Is there anything out of these 4, ArcBest, XPO, Old Dominion, Saia, that we haven't talked about that really stood out to you? Something one of them is doing different or overperforming or underperforming compared to the others?
Well, I think XPO 800 bips of margin improvement through the downturn. And granted, flirting with a 90, high 80, close to 90 OR, they had a lot of room to improve. But they've layered in so much tech, so many AI initiatives, whether it's line haul planning, route pickup and delivery optimization, dock worker optimization, et cetera. I mean, so they have all of these levers. They're getting freight from small and mid-sized businesses. More of their freight now has accessorial or premium service charges on it. So they have all of these different levers that are allowing them to outperform the market. But just directionally, I think one thing, demand, everybody still pushing back on LTLs and saying, the quarter was so great because it was led by fuel. That's why margins improved. The one thing I would say, LTL fuel surcharge programs do have the step function where the percentage of the fuel surcharge increases as absolute diesel prices increase. However, all of their third quarter guides, second quarter to third quarter, were at least in line, if not better, Saia being the one caveat. But that's as their fuel price assumptions, fuel price moves down, that was the base assumption for fuel. So I think that bucks that trend that this is a fuel-driven margin improvement story. It doesn't appear to be that. And then I think you just look at the June to July step in demand. Everybody except Saia, again, the headwind with that GRI implementation. But, you had OD at like 400 bips, 4 points of seasonal outperformance. ArcBest, like 360 bips outperformance. Saia, a little bit of a lagger. XPO certainly had outperformance. So the June to July step, that's the latest data point we have on demand for them, is really encouraging.
It's interesting, Todd. We have not seen really an upcycle since Yellow. I mean, a lot of these guys are sort of have absorbed the Yellow network, absorbed the Yellow volume, and have not had a lot of benefits of that due to the Great Freight Recession. This is the first part of the cycle where, since that transaction went, since Yellow went under, where they benefited from that. And a lot of it was what we call, Yellow was viewed in the market as a low quality service, bottom feeder, and it's out of the market. And I think that's why there's so much, we're seeing these operating ratio substantial beats. in light volume because that consolidation really has helped both volume relative to the overall market, but also price. They're getting a lot more yield. I know, years ago I had lunch with Brad Jacobs, and he talked a lot about Old Dominion. This is a guy running XPO, but he was inspired by what Old Dominion is, and I think the other LTL providers are following that as a model. And so I think we'll see significant earnings improvements as we see additional demand hit the market.
Absolutely. And you're right. I mean, XPO has taken on that OD playbook. So is Saia. And Saia had some network growth. They weren't a true, sub 200 terminals. They weren't a true national carrier. So what I think is interesting is you're right. They've taken on the playbook. It's service first. If I have the service, I can charge the price, which will improve my margins, will kick off more cash flow. And I'm going to take that cash flow. I'm going to reinvest it in real estate, equipment, people, tech, improve my service, improve claims ratios. So it's this virtuous feedback loop where you just get this continual improvement. And that's why OD has gone from, mid 90s ORs almost 20 years ago to sub 70. And that's why XPO had 800 bips of improvement through the downturn. Saia's got a little bit of pause in their story, but they're going to get there as well. And what you don't have this time around, carriers are adding terminals, but 325 terminals went out. So you'll have some argue that there's been a little net door add. I say there hasn't been any. I think our industry, LTL, is still down on door counts, from 10 years ago. And then you don't have someone that's a national, one of the biggest carriers out there leading with price.
Yep.
It's not there anymore. And then you have a renewed commitment from FedEx Freight now that they've spun off from FedEx. So everyone is on the price page and the yield discipline page in LTL.
It's great to be an oligopoly. We cover them often, whether you're an ocean container line and you've got massive market share. If you're an LTL provider and you have massive market share relative, only a couple parties to split it with, or you're a railroad and you get the benefit of massive market share. All of these businesses have incredible earnings potential, and they are investable assets. You should own them. You should marry them. We're going to get into that more later.
Bring them home.
After these messages.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, The sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head-to-head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves today. We're going to talk railroads again. It's one of my favorite topics. This is not Wednesday, in case you're confused. It is Monday. You didn't get the wrong day. But we're going to talk about the mega merger between Union Pacific and Norfolk Southern. We have a different perspective, perhaps, than what we heard last week. We have the Chief of Staff and Vice President of Corporate Relations for BNSF, live from Fort Worth, Zak Andersoe. How are you, sir?
Good. How are you guys doing today?
Great. First of all, I lived in Fort Worth for many years. It's one of my favorite cities in the country. It's not Dallas, but that's what makes Fort Worth special. Always enjoy, and by the way, the BNSF headquarters is like an old historical Western art museum. So hopefully one day, Zak, you'll extend an offer to Jillian and I to do a live remote from your offices there. Just an amazing place, so in touch with the history of this entire country.
Oh, we would love to host you here. Absolutely.
Well, Zak, tell us about last week. We hosted the Future of Rail Symposium. We had both Union Pacific and Norfolk Southern's CEOs in studio. We had the STB, the head of the STB, the chair. Tell us a little bit about what your thoughts are on this merger.
Sure. I mean, I'm sure both of you have seen this from the beginning. BNSF has been strongly opposed. You're introducing an unprecedented level of concentration in an already highly concentrated industry. And so there just isn't really any good thing for a customer using rail in this merger proposal.
And do you think
that's the high level?
I mean, ultimately, intermodal competes with truck, and there's a ceiling on how much you can charge an intermodal. But is really the pressure point on bulk? Is that where you think the biggest sort of, if there's winners and losers, it strikes me that the bulk shippers, the core commodity shippers are the ones that probably stand the most to lose in a consolidated market.
I think that's exactly right, Craig. If you look through their application and what the UP and NS are offering, there is nothing in it for a bulk shipper or a carload shipper. It's all this. The entire premise of their merger proposal is on intermodal itself and the unrealistic growth projections they have for what makes this supposedly work.
Well, I mean,
over 3 years, they're going to grow 17% or something like that.
2.2 million truckloads, which to our audience, that number is always hard to define what that means, but roughly the equivalent of Knight-Swift's truckload, how many truckloads they handle in a year. To me, didn't seem like a massive impact to the intermodal market. It felt like, I wouldn't say it's a rounding error, but it's just not as significant as I think a lot of folks have suggested it is. Is your thoughts differently than that?
Well, I think we more focus on just the scope of it. I think in the grand scheme of things, like you're talking about, the entire market, it probably isn't much. They're talking about, what they call the watershed area, essentially around the Mississippi River, north and south. And, the 2.1 million carloads or whatever it is that they claim that they can convert, it just seems unrealistic. Over the past 10 years, Union Pacific's volumes have dropped 13%, while their revenue per unit has gone up 17%. So that, to me, doesn't say this conversion is going to happen. And they even kind of acknowledge that in this latest supplemental information they filed last week, where for something that's been entirely premised on over-the-road conversion, they say that over-the-road conversion numbers really aren't the best metric a couple years into this to determine whether this was a success or not. So it seems crazy to me when you have premised your entire merger on that and then back away from it.
So, and I could have told you numbers last week, but I have slept and now I don't remember of the percentage of overall rail shipments, NS
intermodal.
Yeah, NS and UT with the percent, and UP
it's over
with the percentage
50%
with
is
BOP. And then you add an additional 13% for the CN, right? I'm sure you know the numbers and should quote them if you do.
No.
But tell me kind of why this new deal with the Canadian National sort of undercuts their argument for why this is a good thing for
Sure.
the industry.
Yeah, you bet. So, I mean, because it doesn't accomplish anything, it doesn't add any competitive aspect to what they've already proposed. And half of it isn't contingent upon the merger. The access to Mexico through Memphis and allowing UP additional access on the EJ&E in Chicago can start before the merger is ever consummated. And one of the key aspects of the new merger rules, new and they're 20 some years old, but haven't been used yet, is that you have to show or demonstrate that the benefits you claim are a merger's required to attain those. And if they just did it through a partnership, well, you kind of proved your own point that a merger isn't necessary. It's very similar in look to what we've had with CSX for 20 years, where we have an interchange agreement to get to Atlanta and then a more recent one to get to Northwest Ohio.
So Zach, I'm just curious, when I look at this from other mega mergers, consolidation, take your sister company in the truck stop world, Pilot consolidation. We now have 3 major travel center chains across the country, one of which is owned by your parent company. It's been good for those guys. They've been able to control pricing and much, we in the earlier segment, we talked about how much better having eliminated yellow is for the LTL business. They now have far more pricing power. What isn't clear to me is why BNSF, I get that there's a service element and I get that UP is a historical competitor, but it feels like from my seat, and of course these are the cheap seats for me to observe it, that you guys would want more consolidation in the rail market where that gives you less pricing competitiveness. Why are you opposing this? I'm just not clear on what advantage you guys gain in actually fighting the merger.
Because we believe it reduces competition overall. That rather than manifest itself and is better for everybody, I think there would be, obviously there's a lot of talk in the marketplace. So would BNSF or CPKC, CSX, is there some other combination this would force? And as I mentioned at the beginning, this is already a highly concentrated industry, and we don't think this is good for the customer at all.
So you're opposing it strictly because you think it's bad for the overall customer across the overall freight landscape?
Exactly. It's too much market power in one company. You would have over 50% market power in this new combined UP and NS. And if this was going through a regular merger process rather than through the railroad merger process, which goes through the STB, the DOJ would toss this for being too concentrated on the face of it.
Yeah, I mean, it's a really interesting. I mean, you have that much market power, and there's been obviously the railroads have consolidated over the last 30 years, been just massive consolidation. I mean, railroads. I've said this on air so many times that the railroads are the dream business to own because of just the improvements that you guys have made, both in financials but also safety. Because you're making the railroads are doing exceptionally well. You're able to make the kinds of, and this is as a group of companies, not BNSF specifically, but as a group of companies, the railroad safety record is at an all-time high, at least in modern history, largely because the profitability of the railroads has enabled them to make money, make money and make investments in safety.
Yeah, that's absolutely right. But we'll go back to it. You asked the why. Why is BNSF opposed? If you look at our industry, what you just said was exactly right. We're all profitable companies. We're at our safest time at any point in our history. We're all investing in technology. We're all investing in capacity. And so what we think this merger introduces is this level of risk to the industry that we don't think it can afford. And frankly, like I said at the beginning, isn't good for customers, period. There hasn't been a single merger that hasn't had some sort of integration problems. And there's been nothing, this scope of what they're proposing. And when there's an integration problem in the industry or a service problem starts to develop, it's like a cold. Everybody else starts to catch it too. And we just think that's too risky for the American economy. And we think this raises prices for American consumers. It almost has to, by definition, because of the level of concentration you're dealing with.
I mean, you can't go through any merger and expect it not to raise prices. I mean,
no,
that is classic 101 economics. Fewer competition, prices are definitely going to go up. I think the argument to that is, if you're looking at intermodal specifically, getting transcontinental rail service is while you may see higher intermodal pricing, it's still got to compete with truck. And truck is a superior service to, even when you have transcontinental rail, truck is still a superior service because you have less handling, you got direct point to point transfer. But it strikes me that there is this service element that, shippers could benefit from. How do you think about that?
We think it's actually overblown, the seamless interline service. Today, as I mentioned, our arrangement with CSX, our agreements, but we also interchange with NS. Our largest customer, JB Hunt, is on NS in the East. And most of those interchanges take less than an hour at these gateway cities like Chicago. So, if you listen to the rhetoric around the merger, it takes out 24 hours, 36 hours. Does it really? Because any intermodal train on BNSF, we'd expect to lose the business if it took that long. Like I said, it's kind of a step on, step off operation, changing crews. And then you also, back to your original question on the carload side, how does that benefit the carload customer? If you got a car of widgets going from Omaha to Buffalo, you're not going to send a single car. You're going to sit in Chicago and wait until there's density for a Buffalo train. And so I don't think a merger really impacts that.
Yeah, it's going to be interesting.
Or provides benefit.
So I want to talk, and let's talk about this in a way for some of our viewers who aren't as familiar with intermodal. But I read that you said that you're open to discussing changes to the TRA structure. So that's the Terminal Railroad Association structure, right? The switching.
Correct. And
what would a good faith conversation specifically look like there, and what would you be hoping to discuss?
Well, I think they've solved that for themselves with this agreement with CN. That piece of it is contingent upon the merger. But what we were referring to when I said that was that UP had called a meeting of the TRA board. So there's a board for the TRA. It's an entity. It has governance. It has policies. And they were saying they want to call a meeting to dispose of the NS shares, so they wouldn't have 50% or more control of the organization. And we said, well, no, you're not talking terms. You're not setting anything. They gave zero detail. And so to your question, a good faith conversation would be, here's what we're trying to accomplish. Here's what we're trying to offer. And none of that happened. And so it just went silent until the recent CN announcement. I guess that was last week.
Zach, I got to ask a different question in terms of security. It's been fraught, this cargo crime, this is a pandemic, epidemic, whatever you want to describe it as, is happening all over this industry. Rails are not immune. We had a story in Trains magazine a couple of months ago about about people jumping on live moving trains. This is a major problem for all modes of traffic. You guys have supported CORCA. How do we get Congress to really move on this, to really put the kind of investment that we need to prosecute these bad actors?
Well, the old-fashioned way, you make the argument that it's a bigger thing than any individual mode, and you clearly understand that from the get-go, that this isn't a rail thing or a truck thing, it's a supply chain thing, and it's been growing, controlled by cartels. And so it's a huge problem, and therefore needs these resources. And I think if we can convey that story, not as individual acts, because you'll see, covered in the press or in Trains, this happened in Arizona or this happened in California. Well, that's in and of itself just one event. But collectively, the cost to the American consumer and the supply chain is staggering. And I think when Congress understands that, they'll move quickly.
Yeah, unfortunately.
And to be honest, it is moving.
It is moving slower than it should be. I think the industry recognizes it. It's not as sexy of a story as some of the other stuff that Congress is dealing with. That's the unfortunate reality. Our industry broadly is not loved as much as we would like it to be. But these are important stories. It's, we also had the head of the Air Forwarders Association on about 3 weeks ago, where he talked about supporting CORCA. I think as an industry, we need to do a lot more education to Congress and to the public about the this epidemic that continues to plague the nation's supply chain.
No, that's absolutely right. And it goes unseen, right? No one sees when this stuff happens. And so, like I said, it's kind of episodic if it's covered by the press, and people don't see the scope of it. Once they realize the scope, they take it much more seriously.
Well, we need to come out to Fort Worth. Again, my son's at Baylor.
Love to have you.
Sick 'em Bears. I know you guys are TCU fans out there. We're going to enjoy beating you this year. It is in Waco.
I don't know about that.
So Zach, we'll have to come out. Maybe we should do a show from that weekend from Zach, we'll reach out. My people reach out to your people.
I'd love it.
We'll try to do an on-site down at the Alliance Yard. You know what's interesting,
bet.
Julie? They have their own police officers. Goes back to the
Real police,
1800s when you had all the train robberies and stuff. They have their own police force. I'd love to go out and talk about rail security because it's such an underreported. That article that's in Trains is absolutely fascinating about these groups. Well, Zach, appreciate it. Look forward to Sick 'em Bears.
All right. Well, thank you very much for having me on today. I really appreciate
you
the
coming on.
opportunity.
Coming up next, we're going to talk maintenance with Trent Broberg. He is the CEO of Full Bay, friend of the show. I've known Trent for a long time when he was at Truck Stop. Going to get into it with him. Why did he get the job as CEO, and what is Full Bay doing to help maintenance across the world?
First, we are going to get into our Sonar update and then hear a little bit from our sponsors. All right, good morning. So today's Sonar update, I want to talk about a little bit about general market overview of what we're seeing in the data and regular seasonality. So while tender rejections did fall last week, really at their fastest rate since April, and volumes fell a bit, we did see an increase in domestic intermodal volumes, and you can really see those moving in tandem, particularly when you look at the long haul tender rejections. For over the road, they really are moving in line with intermodal volumes. So you can see those conversions really happening, particularly because there's really a strong cost differential right now between over the road and intermodal. So I expect to continue to see strong intermodal volumes. And so again, going back to those tender rejections and line haul rates, the last week of July, we did see continued declines in the spot market line haul rates. And while they were more aggressive last week than in prior years, the same week, we're seeing them continue to move along seasonal expectations. And I believe the reason that they were more aggressive last week and fell was because we'd had such a sharp and quick increase earlier in the year. So while spot rates did fall last week, as well as tender rejections a little bit, we're still hovering right above 14%. I want to remind everyone to look at the broader context and that rates still remain from a spot standpoint at record levels. Honestly, the only time we have seen them this high in recent history in the last 5 years was in 2021. So the Sonar NTI, National Truckload Index, even when you look at line haul only and back out fuel, it fell 7 cents per mile week over week from 271 on July 23rd to 264. So it is 12% lower than the 302 record, which was last month. But again, it's still 51% higher than the same level a year ago, which was $1.71. So we're also seeing contract rates continue to rise. So as higher spot rates continue to persist, we are seeing contract rates continue to now inch up. Recent second quarter earnings from a lot of the large trucking companies we have heard from recently are really falling in line and quoting that same concept. Trucking executives have talked about and showcased improving conditions at higher rate negotiations. So we're hearing all of them talk about operating margins improving, but at a slower rate as large fleets continue to reprice their freight mix. We've heard them talking about those contract rates finally coming up and then rising, coming up, and then also those rates that they're renegotiating really beginning to happen in July. I found it really interesting that many of these executives are all sort of quoting and saying very similar things, talking about being in the early innings still of this freight recovery and a tight capacity market. Schneider noted double-digit rate increases on contract renewals in its one-way fleet during its second quarter earnings. They talked about revenue per truck in its one-way segment rising 16% year over year. Their management described the truckload market as in the early stages of a rate recovery. Again, similar to what we've heard from quite a few others talking about the early innings. Again, in the Schneider earnings, they said that the company is using the capacity imbalance to recoup multiple years of cost inflation, and that mini bid activity is rising as shippers are seeking more peak season capacity. And we're finally starting to begin to see a little bit of intermodal rate increase as well. Schneider mentioned low to mid single digit increases with stronger gains in more recent contracts that they've signed. Werner Enterprises in its second quarter earnings said that its one-way truckload operation secured upper single digit to double digit contract price increases on some bids, and mentioned that roughly 60% of its one-way portfolio saw higher repricing in the first half of 2026. Again, all in line with us beginning to see increased contract rates. Heartland Express is an interesting one we've been watching. Historically, they've had incredible earnings, and they've had a bit of a blip recently, but we're starting to see more of what we would expect from them. Their recent Q2 earnings showed dramatic operating improvement, and they reported a 91 OR, which is a massive improvement year over year of what they were showing. And they cited stronger freight volumes and improved customer pricing resulting from ongoing industry capacity reductions. So, all of this is showing better results for all of these large companies as we've seen increased spot rates, but now we're also beginning to see those increased contract rates. I think it's also interesting that almost all of them are quoting looking towards continuing to improve margin, profitability, and utilization before looking at growing. So I'm not seeing any indicators that a lot of capacity will be entering the market to change this current balance where we're seeing lack of capacity really leading to this strong freight market that we are in. So some of the graphics that we're going to show are that NTIL over the last 5 years so that you can see what's happening there this year compared to prior years, where we are seeing, again, as I mentioned, still record spot rates, even when you back out fuel, higher than anything we've seen in the last 5 years. You can also see contract rates continuing to rise, and that gap between spot and contract closing a bit as spot rates are now finally pulling those contract rates up. So as we've said in prior Sonar updates, well, I'll say it again today, contract rates are rising. I believe that this capacity-driven tightness will remain for quite a while.
Julie, I got to tell you, it does feel like we're repeating ourselves every day. And it's more of the same. The market's not changing, but it's not bad. It's good. Spot rates are near record high. It just feels like ultimately we're saying the same thing every day.
Well, I kind of think we are going to be saying the same thing until we get to the end of August, right? I think we're just in this normal freight cycle, normal seasonality. But what I do feel good about, while things aren't necessarily changing, is that everything that we have been saying regarding capacity not entering the market, rates continue to remain strong, regardless of fuel surcharge, on their own merit, spot rates and contract rates going up was also mirrored in earnings and the quotes we heard from CEOs across all of sort of the large carriers and those who we've been watching to report that they're not adding capacity, that their rates are coming up, that they're seeing June and July contract rate increases.
And we're in the
coming
first
through.
inning. We're in the early innings.
Everybody says early innings.
We need to trademark that and get a royalty every time someone says it because they're repeating it all the time.
Yes.
Well, speaking of fraud.
Yes, let's get to our highway segment, Verified. In California, CHP investigators cracked open a major theft ring last week. They traced more than $500,000 in stolen merchandise to a discount store in Rialto. The goods were tied to multiple thefts across Southern California. Authorities returned everything to the victims. In the Carolinas, the recovery was even bigger. Investigators seized 13 stolen semis and 3 trailers. The equipment was worth more than $1 million. 2 North Carolina men are now under arrest. Each faces 9 counts of grand larceny. Our Fraud Watch segment, Verified, is brought to you by Highway. And now we're going to take a quick break. We'll be right back.
Every load you move depends on one thing, knowing who's on the other side. And Highway gives freight brokers the carrier identity tools to verify carriers, secure the load, and book with confidence. The performance guarantee puts up $100,000 behind that promise. Real money behind the standard. No other freight technology company has made that commitment. This is, again, Highway, the standard for carrier identity.
super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head-to-head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Well, look, it is so much happening, and maintenance is one of the, if not the most important thing in freight, it is one of the most important things in freight. And to talk about the state of heavy-duty repair, we have Fullbay's CEO, Trent Broberg, friend of the show. Trent, welcome to FreightWaves today. Let's talk about the state of maintenance, up 68% year over year.
Yeah, thanks for having me, Craig, Julie. This is the third logo I've been on the show, so thank you for having me here. And
third logo at FreightWaves, first logo at FreightWaves today. We've only been doing this for 2 months now, so
that could be problematic, for my career.
But Trent, let's talk a little bit about what is the state of heavy-duty repair.
Yeah, absolutely. I mean, good, not great. I think you just characterized it a little bit before the break. I think you're seeing everything trend up and to the right. You're seeing labor costs up and to the right. You're seeing, technician availability maintains to be a challenge for all heavy duty shops out there. Hiring, training, and retaining technicians is a big issue. Very similar to what you see in the driving community out there on the CDLs. So
Trent, Fullbay was at the first FreightWaves conference. We called it Transparency 18 in Atlanta back in 2018.
Yeah.
Folks that aren't in the maintenance world may not be familiar with Fullbay to the degree that we certainly were introduced. I think it was an early stage startup of those days. It was in the earliest days of Fullbay, if I'm not mistaken. Tell us a little bit about the history of the company.
Yeah, absolutely. It's 10 years old. We focus primarily on heavy duty repairs. We're the operating system for shops out there repairing the trucks that you guys talk about every day. So we have about 5,000 shops that run on Fullbay. We did about $6.5 billion in commerce last year alone. So a fairly scaled platform and continue to grow. A lot of exciting new products coming out.
So labor is obviously the most important piece of the equation when it comes to maintenance. Parts availability we can get to in a second, but labor is always the thing that gets talked about most oftenly and is a consistent problem. I'm going to ask the question because the audience has strong opinions about the quote-unquote driver shortage, but the mechanic shortage, is there really a mechanic shortage, or is it just the skills are not as widely shared with some of the new up-and-coming mechanics and some of the older mechanics that are used to working on older equipment? The computerized systems have sort of changed that. What is the state of the mechanics?
Yeah, absolutely. Very similar to the driving community. As the demographics continue to age, it's hard to train and recruit the younger population out there. But I think many of these shops have programs in place, just like the driving community out there that are driving. And labor rates continue to increase. Labor rates are up about 10% year over year. They were up about 10%, 24 to 25. So labor rates are north of $150 an hour. So it's a great career to get into where you're home every night with your family and kids.
I mean, it sounds like you're talking $6,000 a week if you run 40 hours. I mean, are we talking about diesel mechanics making $300,000 a year? Is that legitimate?
Well, that does happen. Obviously, that's labor rates that are obviously charged back to the fleets themselves. So there's obviously a margin in it for the shops as they continue to provide a service back to the fleets that they contract with. But it is, just as, if you're a professional in the driving community and you're a professional as a technician, you can go out on your own. That's many of the shops that we support today are entrepreneurs out there, or small shops that have gone out, they've been driving, they've gone out, started their own shop, and they're trying to grow their shop today. But yeah, I mean, they can make a great living.
A great career. You don't have to have a 4-year degree.
It is.
You can go to a technical school, which frankly people should do. And these days it's better than going to a 4-year degree.
So I want to talk a little bit more about shop technicians and certainly the numbers of most shops being understaffed. And from my career, I can remember the only thing that we talked about that we had as much trouble recruiting and retaining other than drivers were certainly shop technicians. So is there a long-term fix for that labor gap? And then I guess on top of that, you spoke to the demographics a bit. How do you keep, as an aging demographic of shop technicians, as you mentioned, versus it being a little bit harder to get new younger talent in, how do you keep them up to date with the ever-changing technology? I mean, trucks have changed massively in the last few years. Well, every year.
That's right.
Feels.
Yeah, thanks, Julie. Yeah, that's right. I think to answer your second question first, I think it's really about the products that you put in front of them and how you train them. So learning and development programs. I think just as you've seen in the driving community, there's mentor-mentee relationships, and it's about having the time and making the investment. So the shops that make the investment in the younger or less tenured mechanics to spend time with those that are tenured, that have been on the job and can hear an engine making a noise and diagnose it right from there. Those are the ones that you see that are driving increased revenue per tech, increased efficiency rates, tech efficiency rates out there on the platform. So I think it's really all about partnering with those that have been there and done it before. Absolutely.
Almost like an apprenticeship.
Yes, yeah, mentor-mentee relationship. I mean, there's so many challenges that come to the shops, and remind you that while it's heavy duty repair, there's a lot of off-highway equipment that comes into the shops. So everything from mining equipment to yellow iron, class 8s, all the way down into the light duty vehicles. So it's a mixed bag that'll come into the shop, and you might not know what's coming into the bay that day. So you've got to have a lot of technology to diagnose issues, to really figure out and solve those problems and get the right parts in time. Because there is an opportunity cost lost every time there's a truck in the shop.
So we've noticed and heard reports of, specifically through the downturn, carriers and fleets holding on to their equipment longer before upgrading and trading it in. Has that changed the shape of what you guys are doing, the sorts of issues you're working on? And is that part of what's driving the increased revenue, or is it actually volume?
Yeah, it's actually both. So you're right, the aging equipment out there. So both trucks and trailers are continuing to age. You're seeing north of 6.5 years on average per truck. That skews if you're a private fleet, obviously, or a large fleet out there versus an owner operator in the space. But that average age continues to increase, and I believe it's at the highest marks that we've seen in 10 years. Trailers are no different, so those continue to age, and obviously you need to care for that equipment coming through the shops. The acquisition cost of new equipment is really expensive these days, especially for those small carriers out there. And the more that they can be maintained through PM services, predictive maintenance, and some other AI solutions, the better.
One of my favorite debates, we'll call it, or arguments on X, is this idea of the old school steel trucks versus call them the plastic trucks, the drivers like to call them. I think they're really talking about the Peterbilt versus Freightliner camps in terms of what trucks look like. But one of the things that sort of strikes me from someone who, I don't drive a truck, for a living. Certainly have driven them before around the lot, but I don't have an appreciation for how these trucks are built today versus how they used to be built. I know if you go back in the 1960s and 70s, these things were just like tanks. They've improved significantly on safety. They've improved significantly on technology. But what is the state of trucks today? Are they meant to last longer? Or have we seen an erosion and quick turns as the manufacturers have tried to just maintain margins in a really difficult climate?
Well, I think that the online debates are probably more around regulations than they are anything.
Well, there's certainly that.
The newer trucks that you buy, what's that?
There's certainly no doubt about that. But I love the whole plastic truck conversations. Not one that I was aware was out there.
Yeah, absolutely. You know, I think as everything, they're not made like they used to be is a common quote. But you know, trucks these days are providing so many other advantages, whether it's fuel mileage, efficiency, some of the regulations, and some of the products that are out there in the market. So they're just more complex. So when you think about the repairs that need to happen, there are a lot more systems that need to go into place. There are a lot more checks that you have to do when you intake a truck. There's a lot of DOT checks that you've got to make sure that you're passing before you release that vehicle back out into the wild. So, you know, while I can't speak necessarily to the old versus new build quality, I can tell you that, you know, the majority of the trucks are out of warranty that are going to the shops, and you know, the opportunity cost is like a week on average when you put a truck into a shop. So the more you can be preventative and take care of these assets, the better off you will be in the long term.
So speaking of that preventive and predictive maintenance, can you talk a little bit about I believe you have an AI first platform. What does that mean in practice? And what are you guys doing with it?
Well, yeah, what does it mean? It's a great question. I think you see that everywhere where it says AI first, AI native. I think the way that it means to us is, you know, we're thinking of things much differently than we did, Craig, when you mentioned back in Atlanta 10 years ago. Actually, today is an exciting day. This week and this month is an exciting time for us. We're launching today our first AI receptionist product that's in there. So all these shops that are out there can take advantage of Claudia, our new AI receptionist. We've got a couple other AI products in market, but most excitingly, Julie, what you mentioned there is we've got a new platform coming in just a couple weeks that was rebuilt from the ground up, AI native, AI first. It allows us to take advantage of everything that technology has to provide today. So we're going to be providing a lot more data, a lot more insights, and just a faster development cycle back to our customers.
Trent, my co-host for Freight Expectations, Matt Luffler, likes to remind the audience every show that 20% of trucks on the road are not roadworthy, largely due to maintenance issues. What is the general state of maintenance in terms of trucks over the road? Why is it that trucks are typically not roadworthy? What's the primary reason? Is it money? Is it just the time it takes, the delays? What keeps fleets from doing the kind of work they need to do in these things?
Yeah, I think it's opportunity cost. You know, it's a challenge out there in the space. It's awareness first. So do you have a light out? Why does it make it not roadworthy? Are you doing the proper inspections pre-trip and post? When they're in and out of yards, facilities, shops, are you doing the DOT inspections? So I think that's first and foremost, it's an awareness perspective. And then as you're thinking about just the scheduling of these services, on average, when you schedule it, it takes 4 days to get into a shop. So when you think about, there are just some gaps in what's happening in the space, and those are all opportunity to make a margin. It's been tight the last 4 years. Market's good, not great, as you kind of mentioned, and we mentioned earlier. And I think there's just a lot of check boxes of opportunity out there in the space. So, you know, I think fleets do the best they can. They contract with good quality shops, but there are so many variables out there that it's tough to check the box on all of them.
Is your hope that Claudia? I got to be careful not to say Claude because I don't know. I mean, I don't work for you. I'm not your marketing person, but Claudia and Claude feels like that's going to easily get misconstrued. Do you think that's the greatest name you could have picked?
Hey, you know, that's my marketing team, and I think we're sticking with it. I think it's launching this morning, And it was actually the name of an AI agent that we have been playing around. We made an acquisition earlier this year. They had actually had that out there in the space and pre-Claude. So we just kept it and kept rolling with it.
I'm going to get banned by their marketing team for knocking the name. To me, it just sounds, I heard Claudia, it just.
I don't know, I think it makes you think AI right away.
That's true. That's a good counterpoint, It does make you think AI. Trent, I got to ask, you had been around the industry, have had some fantastic opportunities. You were at Swift Transportation, then Truck Stop, then you were at Acertus, and now you're at Fullbay. What have you learned about different businesses? What has surprised you in your journey? I'd love to just start when you went from Swift to Truck Stop. What was the biggest sort of experience and sort of eye-opening back there?
I think going from the largest carrier to a product that services owner-operators primarily at that time, that was a big notion. So what works for a large fleet and a large carrier at the time didn't necessarily work for an owner-operator. I think it's an opportunistic industry. I think whether you're large, medium, or small, the opportunity is always there for you to take. And how you take that means a lot in the long term. So there's always the argument around shipper, carrier markets. Do I take price where I can? Do I take margin where I can? Do I give? And what you see time and time again is the sustainability of the relationships that are out there that you can drive in a roller coaster market. It's a give and take market. Cycles run every 3 to 5 years. So the relationships that you establish can help you in those down markets. But that's been the biggest opportunity. Now it's obvious, but it's hard to execute. When you have the opportunity to take margin, should you take all that margin that you can?
It's interesting. I mean, this is a market where you can get margin, or you haven't been able to enjoy that in the last 4 years. And those that aren't taking margin, the carriers that say, quote unquote, committed to their customers during the upcycle in COVID may not have benefited as the down cycle started. I mean, loyalty is always, everyone's like, this is a partnership. Usually the people saying it's a partnership are the ones that are on the losing end of the leverage. I mean, they're the ones that have lost leverage. I mean, that's just the nature of freight. And then you went to Acertus, which is an automotive platform, transportation platform. What was the difference between sort of the over-the-road market? Truck Stop is certainly a leader in that over-dimensional business, but outside the automotive movement of cars, what was the difference there?
Yeah, obviously it's a higher value product moving out. It's a higher touch. Claims rates are a challenge at times, but again, it's the same type of mentality. It's about the relationships that you make and how you drive the commercial activity in the business. I think what was really eye-opening there that we learned at Truck Stop and we converted over to Acertus and now Fullbay is really around how do you surround the customer with more products so you're not just a point solution for that customer, and helping to drive at Acertus, we brought in title and registration, storage, care and maintenance, and many other products to help these customers that were using multiple vendors at the time. And I think, by and large, it's been such a relationship driven business throughout the years that you've really got to cultivate those, in good times and bad.
Well, so much going on, Trent. You're always fun to follow your career because you're sort of in there. I got to ask, Fullbay, what was it attracted to Fullbay? What was the sort of the nail? I wouldn't say nail in the coffin. That sounds bad, but the handle on the cake. What was the reason you went?
Yeah. It's the opportunity. Fullbay's here in Phoenix. I live in Phoenix, so that's primary. I can be a full-time dad, a full-time reliable coach. These things, I've got 2 boys out there. Shout out to them. They're watching me. But it's really the opportunity that exists at Fullbay. It's there really isn't a competitor out there in the space that's delivering with the product that we have in heavy duty repair. I've hit every other cycle in the industry, whether it's global freight forwarding, fleets, and other technology. And this is really an opportunity to pull it all together. So we'll be continuing to drive, a platform of Fullbay, not just a product out there to help these shops and ultimately help the fleets turn their trucks quicker to get them back out in the market. Because back, as you mentioned earlier, the driving community, the trucks out there really drive everything, and our ability to get them back on the road faster really helps everybody.
So Trent, if you had one choice of a company you could come back and own, and we've asked this question Intermodal, LTL, truckload, forwarding, or own a railroad. Which of those would you pick?
If I could own railroad, no, for lots of good reasons.
I still think that's the better choice. Julie, what about you?
Yeah. I mean,
Financially
it's
better choice,
obviously
yeah.
more
Railroad's
sustainable
cool.
and larger.
Like they just literally print money and keep the nation like so tied to history. My father wants to have the JV Hunt contract. He can't give up trucking. It's a habit that he'll never give up. I still think the railroads are the way to go. So maybe you and I will have the railroads and we'll charge my dad intermodal time.
Yeah.
So,
When they're running on
are
time
your kids
and everything's run
football?
smooth. Yeah.
Is it football? Is this what your boys play?
Boys, all the sports possible: basketball, football, soccer. We're in the mix right now. I've got a 12 and a 9-year-old.
Well, best of luck to the season. It's fall sports coming up. It's my favorite time
We
of year.
started. We're like in full soccer swing already. Practices had 3 games on Saturday.
Amazing.
School starts
I
tomorrow.
love this time of year. My wife loves it more because the kids are out of the house. But it's football season. So
Oh, nice.
appreciate it, Trent. Thanks for coming in.
Yeah, thanks, guys.
FreightWaves
Appreciate you
today.
having me.
We'll have you back. Next up, we have Brian Fialco. He is the Executive Vice President of Risk and Resources. Executive Vice President of Risk Resources. He's going to talk about risk management. He is somebody that knows this business very well. He's written a book on it right after these messages.
In today's freight environment, every second of uptime matters. Of course, maintenance is inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Love's understands that operational pressures demand a nationwide service network for better visibility, actionable intelligence, and consistent execution, all of which you protect your assets, reduce your total cost of ownership, and maximize your uptime. Maintenance is, of course, inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Learn more.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. We're on a roll, and we're getting into risk management. Our next guest, Brian Fialco, knows all about it, has literally written the book on it. Going to join us. He was, we most recently knew him as the CEO of Jetco. He's going to tell us about his new nameplate. Brian, welcome to FreightWaves Today. I think I got it wrong. I misread it. You're not with Risk Resources. You are the EVP of Risk Resources at Acrisure, so I apologize for that.
I am. Thank you. It's so good to see you again. It's so great to be with you.
Well, we're happy to have you. Tell us a little bit about Acrisure, exactly what you guys do, and what does the Vice President of Risk Resources do for Acrisure?
Well, Acrisure is a leading fintech in the insurance space, and it's become the sixth largest insurance broker in the country. They've got worldwide operations, and my role at Acrisure is to help clients manage risk, because as clients better manage risk, they can take better control of their insurance costs and they improve financial and operational performance. So we've built a risk management team that helps clients take control of risk, and we focus on the variables that we think drive safety the most. And it's been fun to bring all my experience, my years in the trucking industry to that, because a lot of what I've learned, sometimes the hard way, I'm thrilled to be teaching other people how to better manage risk in their businesses.
So many people feel like safety and productivity can sometimes be competing priorities. You say that is not the case. The safest companies are usually the most productive ones. So can you walk us through that and how they can be beneficial versus competing priorities?
Absolutely. People that say safety is expensive, I've got news for them. Consider the opposite. I mean, safety is actually the lowest cost, highest return investment you can make. And in my experience, I believe that safety is at the foundation of operational excellence and at the foundation of productivity and profitability, because the safest companies get it, right? They spend less time cleaning up the mess. They can spend more time on productive endeavors. They're not having to talk to customers about why the cargo is on the road, why the load is late because of a crash. So to me, the more you focus on safety, not as a department, but as a leadership endeavor, holistically, everything else falls in place. I mean, I've seen that in my own business. I've seen it, quite frankly, when we've kind of gone backwards. And I've seen it with countless other companies now too, firsthand, that the safest ones generally are the most productive and profitable. They don't view safety as a department, something that's in the corner, something that's there, when there's a problem. It's leader driven. Leadership casts the shadow that the rest of the organization lives in, and safety has to be front and center for it to take hold long term in the company.
How do you make safety really permeate the entire culture versus being just a department?
I think that it has to start at the board level. I mean, boards and ownership groups of companies have to understand that safety is part of healthy, robust enterprise risk management. And when that attitude permeates, then the company will understand that we're not going to negotiate safety. Because look, in trucking and logistics, we have a lot of pressures. There's deadlines, right? We run late. There's traffic. There's all these things that get in the way and make shortcuts look real convenient. But specifically to your question, in order to get safety to take hold, it's got to be leader driven, but there has to be employee engagement around it. Your employees, your teams have to own safety. In the freight industry, notwithstanding the advent of telematics, notwithstanding how much more visibility we have, we still have to be sure that our teams are doing the right things when nobody's looking. And that means empowered to call a timeout. If something we might be under a deadline, right? But if something doesn't look right, we stop, we figure it out, and we move only when it's been addressed. So it's about leadership, how leaders show up. It's about employee engagement, and then it's about respect for process. There can be no tolerance for shortcuts. Process has to be clear, understandable, and non-negotiable. If those three things are in place, right? Leadership, employee engagement, and clear process, you've got the makings of healthy safety performance.
So Brian, our audience probably knew you as the CEO of Jetco. Certainly the last time we talked when you were in that role. One of the interesting things is when we had you on FreightWaves TV, you really focused a lot on safety. You did a big presentation on safety and trucking, really what it took, which was unusual to be a CEO of an operating company and then just very, very focused on safety. Where did this passion for safety really hit you?
You know, I'm not really sure when it came in that way, but I can tell you that we were insured with Great West Insurance at the time, and Great West came to me and said, you know, your company's performance is historically a lot better. You know, you're kind of in the very top performers. Would you speak to other insureds as to why? And I was like, well, sure, and that got me to understand that maybe there was something that we were doing that we needed to share. I mean, when it comes to safety, there's really no competitive secrets, right? We need to share best practices. And so maybe that sort of lit a little fire that I had something to give beyond just what we were doing inside of our company. But then, you know, the market talked to us too. We were attracting customers and retaining customers because of our safety reputation. Same thing with value-aligned employees. And as I progressed in my career, it became really clear to me that safety wasn't just, again, you did it because of, you know, the FMCSA, DOT. Safety became kind of our core value. It became our brand. Customers knew us for that. Now, did every customer appreciate it? Of course not. But the ones that you wanted did. And what it wound up doing, Craig, is it wound up narrowing greatly our pool of competitors. Because when you have customers, and more do, especially now in the post-Montgomery world, it's only going to increase where you're vetted for your safety performance. It's a gatekeeper. It gets you into some of the best opportunities. So I guess it was just a mix of safety being the right thing to do. It seemed to be a great way to attract the right employees and a way to build the business. And quite frankly, since I've stepped away, I think it's gotten only more important in this industry. And now, again, in the post-Montgomery world, watch out.
So is it rewarding going from an operating company to working for an insurance company and really evangelizing this across the industry? I got to imagine it's frustrating in some aspects because you're not touching the trucks and you're not implementing your own policies. In many ways, you're consulting with businesses to have them do it. But I also have to imagine it's got to be rewarding to help share and evangelize this across the industry.
Well, Craig, it is. And again, after, you know, so I grew Jetco, sold it. We sold it to the GTI group in 2019. I stayed through 2022 and then stayed on the board of GTI until it was ultimately sold to Canada Cartage. But when I stepped away, it wasn't going to be to retire. For me, retirement would never be in the cards. It's more reinvent. This is what I wanted to do. I wanted to help other companies. And you're right. Well, it can be frustrating. Sometimes you look at something and it's so obvious. Why aren't people doing it? In more cases, it's like, you know, when there's nothing more rewarding than when somebody sees the light go on, like, oh my gosh, right? This didn't really cost me any money and this wasn't that tough. And they can see the benefit. So that's really been the magic to doing what I'm doing, which is, as you said, helping people and people start to see the connection between safety, not as a department, operations and productivity and profitability, and ultimately enterprise value.
So I feel the same way about pricing, by the way, and now it being at Sonar, like I'm not controlling a network anymore, actually pricing RFPs
which is better,
or doing.
Which do you find more rewarding, being in the action and doing the work or sitting on the sidelines?
Different parts of it. Like when I was managing a spot board team and like you had that dopamine hit at the end of the day being like, I won
You won some
$100,000 of
business.
freight today or whatever it is, right? But now I feel like I get to look at it I get to look at it from a broader perspective, and I get to have more input in larger ones. And exactly what Brian said, like when we'll be talking to one of our customers, like, oh, have you thought about doing it this way and using this metric to do it? And then they're like, oh my God, that makes so much sense.
Brian, Julie talked about the dopamine hits. I can imagine you're in the reverse dopamine world. You don't want dopamine hits in insurance and risk management. Is that right?
No, not really. I mean, the dopamine hit is definitely the job well done, right? But when you see people doing the job well done, but you don't want the dopamine hit. Like, look, when I ran Jetco, sometimes the phone would ring with news you don't want to hear, and so your adrenaline gets real high, and so there's days I miss not being in logistics, and days I miss not being in the game. But again, I've learned so much over the years. It's really more fun at this stage of life, this stage of career, to help pass that on.
Yeah, and it's probably very similar to what we do here. Is we get to be in the action, but not a part of the action. We're still connected to the industry in many ways and evangelizing it. Someone described it like it's like being in trucking without service failures, which is anyone's had a service failure appreciates. You might get the call at 2:00 in the morning, but it's not because the truck broke down or had an accident. So, well, Brian, thank you so much. Your book, where can people find it?
Making Safety Happen. You can find it on Amazon, Barnes & Noble, any of the online retailers, audiobook, hardcover book, ebook, you name it. And I'd love to hear your comments if you read it.
And what will they learn? Like, what's the biggest takeaway?
The biggest takeaway is actionable ideas. We don't have time for theory in the book. The book is ideas how to make safety happen. We're meeting the reader where they're at. And people can skip through the book. So the key is you don't have to read it cover to cover. I wrote it the way I read, which is kind of skipping around. So I want it to be accessible, actionable, practical, and full of checklists. I hope that one idea flips the switch for the reader. That's my goal.
Brian, thank you so much for sharing it with us. We, hopefully our audience will find it interesting to be able to pick up that book. Please come back and tell us about safety. I know this because I've known Brian for many years. This isn't just a job for him. This is a passion project.
Yeah, it's his calling. And I will tell you, I can't imagine a time where this is more important or more pertinent than in our current liability, risk, litigation environment.
Montgomery, post-Montgomery, even more important. All right, we'll be right back. We're going to talk about what autonomous trucks are doing out there on the roads and why trial and plaintiffs' attorneys don't want them to succeed. Back with us.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, The sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head-to-head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
So welcome back to FreightWaves Today. Man, this is one of the most interesting reports I've seen out there about autonomous trucks, and it has to do with plaintiffs' attorneys. So our guest, Alex Tabarrok, he is the Bartley J. Madden Chair in Economics at George Mason University, wrote a white paper about autonomous trucks and why plaintiffs' attorneys are fighting autonomous trucks legislation. They are lobbying against it. Alex, welcome to FreightWaves Today.
Great to be here.
So let's talk about it. I mean, at the end of the day, the data is very clear that autonomous trucks will be safer once implemented fully. Like, there's steps of this, but when we get to a place where we truly have driverless trucks, these trucks will be safer than human drivers. I don't think anyone's disputing that. Maybe some of our driver audience would disagree, but it's the plaintiffs' attorneys that are rallying against it. Feels, not shocking for those at FreightWaves Today. Plaintiffs' attorneys are really after their own agenda. But tell us what your white paper said.
Sure. So what we know the most about, of course, is autonomous vehicles, not necessarily trucks. And the trial lawyers have been lobbying against them since like 2017. So they were ahead of the game. But, at first they said, well, it's a safety issue and so forth. But we now know, the latest study from the Independent Institute for Highway Safety, which is put together by the insurers, they found that Waymo gets into 67% fewer accidents. So 1/3 the number of accidents and only 20% as many serious accidents as do human drivers. So in human terms, we have about 40,000 deaths every year on the roads and the highways. And if we replaced human drivers, which we're not going to do right away, but if we replaced human drivers with Waymo, we would have, 20,000, 25,000 fewer deaths. And that's just with today's technology. As the technology gets better, the crash rates are going to go down even further. Many of the crashes involving Waymo is a human driver hitting a Waymo, right?
Yeah, right.
Not the Waymo going wrong.
Yeah,
So,
no, it's interesting watching these videos of people don't know how to react to them, but they also don't realize in often cases that they are driverless vehicles.
Right. So, the people against the autonomous vehicles have been the trial lawyers and the Teamsters, as you probably know. They're worried about their jobs, which is understandable. But from my perspective, the number of lives at stake is really very large, and we could be doing much, much better with the autonomous vehicles.
So Alex, what did you guys learn in your research? I mean, it's great headline, plaintiffs' attorneys again. Give us some details.
Yeah, so it's quite interesting because we are going to need a new set of regulations. So historically, the federal government, regulated the manufacturing and design of vehicles. The brake system, the steering system, what sort of safety features and so forth. And drivers were licensed by the states. Well, now if you have an autonomous, vehicle, who's the driver and who should license the driver, right? So it's pretty clear that we would prefer that the federal government license autonomous vehicles. We don't want 50 different state regulations for Waymos or Teslas or other self-driving cars. So the main bill has been all about trying to move the regulation of the vehicle to and of the driver to the federal level, and that's what the trial lawyers have opposed. They're worried that they won't be able to sue, which is not actually a part of the bill. But they're worried they won't be able to sue. And look, most tort claims are actually auto claims. That's the bulk of what a plaintiff's lawyer makes money from is auto claims. So they're my view is that they are worried about losing a big part of their business.
And trucking has been a poster child. I mean, you can watch every billboard attorney, the TV commercials as they're going to hammer the truckers. And look, we've covered this extensively on this show, is that a lot of times it's the driver itself did something, was negligent in something. That's where they try to exploit it, is really that piece of it. It makes sense that a lot of it's much harder to ascribe big claims against an autonomous vehicle than it is a truck driver that does something reckless, because the computers are more predictable and more regimented. They don't get tired. They don't do substances. They're not drunk. They're not doing drugs. There's a lot of that. And their error rate, as you mentioned, are safer generally, and they don't get distracted. Distracted driving is one of the biggest cause of fatalities. But ultimately, they're fighting against, one of the problems I have with plaintiffs' attorneys is they argue they're making the road safer. That is their high ground. But clearly, in this case, the data says otherwise.
Well, yeah, really, to turn that into a question, what is it that they are? How are they? I understand the Teamsters and the jobs, right?
That would make sense.
The attorneys, what is it that they're opposing?
They want money.
But they can't. Obviously, they can't say that.
So
they have to be making some sort of claim.
Of course, they're not going to say that.
They have to be making some sort of claim, right? So what is it that they could be saying that why they oppose this autonomous technology?
Yeah. So they started out, way back in 2017 by talking about safety. And, it was more plausible back then than it is now. But there is, I think, a general fear of these kinds of things. Most people have not driven in a Waymo or been driven by a Waymo. I have a few times. It's very, very cool. And it does appear to me to be safer. It's a very calming. The first time you're in a Waymo, you're oh my God, this thing's driving itself. And by the second or third time, you're just reading the paper. It's fine. You're totally used to it because it's very smooth. So that's the story they sell. And they also had an argument. Well, we want to still be able to, sue the manufacturers. Now that actually, whether you like it or not, is still the case. Like even with the bills, which the trial lawyers were opposing, these still have the right to sue. And so that's not going to go away. But I think they do see that there are going to be fewer accidents, and they make a lot of money from accidents. It's sad.
How much of the fight is direct versus, I spent time with some lobbyists that describe the effort that they do, and a lot of times they'll fight an issue that is not directly. So they want to kill a bill.
Yeah.
They will actually they won't go out directly because they know it's unpopular to do that. What they'll do is they'll load a lot of stuff into the bill that they know is going to get is going to get voted against. How are they actually fighting this? Is it direct? Was your research show that they were actually doing it directly, or is it a lot of sort of passively fighting it?
Yeah, sort of passive aggressive, right? So they claim one thing, but then when the bills are adjusted and changed, in reasonable ways to reflect their concerns, like the main bill we were talking about, I think was the a SAFE bill. There's a specific clause in it saying that nothing in this bill overturns common law rights to sue. You would think that would satisfy the trial lawyers, but no, it didn't. And that kind of suggests that maybe that wasn't their real concern, right? They really are just worried about, well, there's going to be fewer accidents, and that's going to cut into our bottom line.
We're
Now,
shocked at FreightWaves today that the plaintiffs' attorneys
yeah,
are fighting something that
yeah,
benefits themselves.
yeah. Look. I mean, to be fair, every industry does this, right? I mean, the taxi drivers, fought Uber, and Uber at that time was, look, we are for freedom and we are for choice and for consumers. But now Uber is fighting Waymo. Okay, so that story kind of went out the window. But this is what almost every industry does. The physicians, they don't want nurse practitioners. The dentists don't want dental assistants being able to do more of their activities. So this is not something new, but it is unfortunate that these veto players have such a strong role in government that they can oppose progress and oppose it in a way which could eventually be costing many thousands of lives.
Yeah, follow the money. I mean, that's the sort of bottom line on this. I mean, I guess in some ways, having Google, Waymo is a part of Alphabet. Have they spun that off? Did Waymo actually get spun off, Alex, or is it still part of Alphabet?
I think they're still part, but don't quote me.
I think
on
they're
that.
truck operations they may have done. Anyways, but you get these massive companies that this isn't different than a small Uber in its early technology was sort of emerging. It was growing really quickly. We're talking about some of the largest companies, and the auto manufacturers are wanting autonomous as well. They've invested significant resources. So it's going to be a fight of the behemoths. You've got the plaintiffs' attorneys on one side, and you got these very large manufacturers and service providers on the other. It just feels like this fight is going to be played out with a lot of money and a lot of lobbying.
Yeah, I think that's right. And really, Google and Waymo and Tesla, they have not actually begun to fight that much. They've been focused on getting the technology, up to scratch. Waymo seems to be most of the way there. Tesla is still somewhat behind. The figures that I've been quoting are about Waymo. They're not about Tesla, not yet. So I think we haven't begun to see the battle in full force yet, but we will. Yeah, we
Is there
will.
a
I do
risk?
think
Keep in
Waymo is
mind,
starting to fight in the court of public opinion, though. I've seen a lot of
Of ads.
commercials from Waymo and about how it makes it safer and how it's about you and not the driver.
But is there a risk, though, at some point that if we do get some statutes on the books where if maybe they're not spending the money on lobbying, that all of a sudden it's just hard to overturn that? Or are they just saying,
Absolutely.
look, we'll let it play out and sort of keep our head down?
Yeah, no, I think Waymo and Google and Tesla need to get on the ball and start fighting back. Because look, I mean, here's the crazy thing. We're going to have autonomous cars before we have autonomous, railroads, right?
Yeah.
Or subway, all
Well,
right?
the railroads have the unions control so
Exactly,
much
that's my
power. And
point.
we've seen the two-car, needing two engineers per car or per train
Exactly.
got put into the law under the Biden administration. That happened a couple of years ago, which does seem kind of crazy. But I also am somewhat sympathetic to the railroad operators, the engineers, because the railroads make so much money. We're huge fans of the railroads, by the way, Alex. I am at least.
Sure.
But I still kind of understand the argument because you have these massively long trains. It's hard to make the same argument in autonomous vehicles.
Well, yeah, I mean, I'm a fan of railways too, but we want cheaper, better, more railways, and autonomous might be a way of doing that. Or if you don't want to talk about railways, we can talk about the subways, right?
Yeah, well, the labor is
Washington,
not a
D.C.
huge piece of the railway. If you think about it from a labor cost perspective,
Yeah.
relative to if we're talking taxis or autonomous vehicles
Or trucks.
labor is a much bigger portion of it, which is why I don't have a ton of sort of skin in the game in terms of which the two-car, like it does feel a little bit more of government intervention in the railroad side, but you're also like, hey, these companies are 55 OR companies with 45%
They can pay two
profit
engineers.
margins.
Yeah.
I don't know that you get too worked up over that. Railroads seem to have other fights as we keep covering on the show. Alex,
It's just
where
a much
does this
simpler.
go?
It's just technologically, it's just a much, as far as I
For
can
sure.
it's just a much simpler problem to have an autonomous subway. I mean, it only goes on one direction.
Well, I know. I mean, I think the Atlanta airport subway is
Yes.
fully autonomous. You can go
Yes.
overseas and see the autonomous. Good point.
Yeah, and where you do go overseas, like Australia, has autonomous hundreds of
Mining.
miles of
Yeah.
autonomous railways for mining.
Yeah, Rio
Exactly.
Tinto has done amazing. These massive, big vehicles are
Right.
fully driverless. But there's also nothing but kangaroos and scorpions out there, and everything that wants to kill you, spiders and all sorts of stuff. Well, Alex, I think the bottom line on this is, where does this end up? I mean, are we going to see more investment at the state legislative area to sort of put this on the books to block? I mean, there have been some rules, some municipalities in California that have banned autonomous vehicles, particularly in the heavy-duty trucks altogether. Do we see this going through the state legislatures to try to put things on the books, or is it all going to be fought at the federal level?
I think logically it will be fought at the federal level because it just doesn't make sense to have 50 different rules for autonomous vehicles. Everyone, I think, can see that that is kind of crazy. Now, there will be some attempts to fight it at the state level, but I think the logic is that it's going to be at the federal level. And I suspect, I don't know, but I suspect that Waymo will actually win. It may take longer than it should, but the experience, like I say, once you've been in a Waymo, you're not worried anymore.
I mean, that's sort
It
of like
really
the
is.
same.
I did a ride along in an autonomous truck a few years ago at a FreightWaves event, and
Yeah.
I really felt
You
the
felt comfortable?
same way. Yeah.
It reminds
Yeah.
me of when Uber, I'm talking about
Exactly.
the app first came out. It was weird to get in some dude's car
Yeah.
and like have another person, a human, drive you.
Right. I mean, what did my mother warn me about, for years? Never get into a car with a stranger, right?
Yeah,
We
right.
told our
You're getting
kids.
into it with you're getting into it with a computer.
Exactly.
It does interesting. I do wonder, and I don't know if you have any thoughts on this, Alex. The AI backlash that we're seeing across the country, where data centers are being blocked. There's this anger and vitriol towards AI data centers, which, in my opinion, are way overblown in terms of what they do to communities. But there's just so much vitriol. I think a lot of that was actually caused by the AI companies themselves, with their own commercial interests, thinking naively that they could tell the story of this replacing jobs, and all of a sudden, then this became a sort of a lot of special interest groups started to fund it, including some state actors. The sort of AI data center fight. Do we think that the autonomous vehicles are going to have the same level of sympathy to the AI haters, or the AI haters have? Are we going to see this NIMBYism show up, or do we think that the public is going to be largely supportive of autonomous vehicles?
I think the public will be largely supported if they get to try them out. And I think the Uber example is really key there, because what happened with Uber is that they moved so quickly that the regulatory system didn't have a chance to catch up until people had taken an Uber and gotten used to it and thought, hey, this is great. This is much, much better than the previous system. So if Waymo can get into enough cities where people can actually try them out, and then you have like elderly people, right? Are going to be big supporters, I think, of Waymo. It makes a life much, much better that they can increase their mobility. And I think prices will fall. Waymos will be cheaper than taxis, and they will be cheaper than Uber. Not now, but they will be. So I think that is going to be a big driver. So I think the writing is on the wall. The only question is, how long is it going to take, and how many people have to die before we get there? But I think once people have a chance to try the technology, they're going to like it.
Well, we need to bring back Travis Kay, because Kalanick did not care about the pressure from the taxi unions. Talk about negative press. He got a ton of it. There were a lot of public hits on him in terms of just bad press. But he was,
absolutely.
It took his
key driver
ruthlessness.
of progress. Yeah, sometimes it takes somebody ruthless to drive progress.
And I think, I remember when Austin, Texas blocked it was the first major city in the United States to block Ubers, banned them entirely. And both Lyft and Uber pulled out. They eventually returned, But there was a desire not to basically, we'll call it negotiate with tariffs. I think is sort of the analogy at the time that was used is, look, we're just going to fight this because they thought that the mission was more important than kind of giving into one city.
Yeah.
The
I think
citizens
you're
of
right.
Austin brought it back. I mean, the citizens
Correct.
demanded their Uber.
Correct.
So,
And it became a big embarrassment. I know in Vancouver, they banned them for a while. And it just became a big embarrassment of people getting off the plane and they're trying to get their Uber and it's not there. And it's just like, why is Vancouver, such a weird city to have this rule where all these other cities, I got my Uber right there. So it became an embarrassment. But more generally, I think AI, this is an AI product, which people will actually like. The other one, which I think we're not there yet, but I think will happen, is pharmaceuticals. If we get a lot of pharmaceuticals, anti-cancer pharmaceuticals coming out of AI, which is entirely possible, again, we're not there yet, but I think once people begin to see that, then they'll be much more excited about AI.
yeah, it's interesting, Alex. Just someone, again, one of my favorite topics are GLP-1s and really what we're seeing with personalized medicine and all of these peptides that have popped up and to be able to sort of take control of your health in ways that we haven't. It's interesting because it's still murky and it's hard to know because of the regulatory environment is very slow. It's hard to know whether these sources are legitimate or not. I mean, the research is pretty clear that peptides are good for, many of them are good for you. But the problem is you don't know the sources. You don't know if you can trust it. That's one of the nice things about the FDA is it ensures that you can trust it. I think that's going to be something that's certainly going to change human health.
Yeah, I wouldn't be buying my peptides from China, which a lot of people are doing and making themselves.
I haven't done that.
No.
I know people who do. I know people who particularly in the bodybuilding,
Absolutely.
that are very active in sort of that world, do it, and they swear by it. I don't know. I'm not brave enough to do that. So
Same.
we'll choose more legitimate paths. So, Alex, we'll have to have you back. These are interesting conversations. I got to get your thoughts before we do. Any the eVTOL market, the flying taxis? Any thoughts there?
Not my field. I'd be. I haven't seen too much. You guys would know better than I would. I'd be a little bit worried about taking one of those, but what I am. I'll tell you what I am excited about, and that is drone delivery. Especially for the last mile. I'm a big Amazon customer, and it is kind of crazy that when I order, some toothpaste, I have to have a car, come deliver this box of toothpaste, while a drone would cut those costs, by a tenth, a 20th, easily. So there are a lot of packages where the last 5 miles could be delivered by drones. And so I think that's very exciting. Would cut the cost. Obviously, you cut the cost of the driver, you cut the cost of the car, you cut the cost of the fuel. So I'm a big fan of drone delivery.
Yeah.
Me too. As a
Zipline is
pilot,
starting
I just don't want them in my way when I'm flying my airplane. That's all.
Zipline is starting to do that with
Zipline has
Super Bowl
done that.
Yeah.
In fact,
Zipline is starting to do that. Yeah.
We're going to the Up Summit this year, Julie. We'll be broadcasting live from the Up Summit, which is hosted by Up Ventures in partnership with Hillwood, where they actually you'll see the future of drone delivery.
Cool.
I want my burritos. The average consumer spends $400 a month on grocery and food delivery. It's astounding. And so again, same idea. The thought of getting your food or your groceries delivered seemed such an antithesis 6 years ago until COVID and everyone kind of needed it. So.
And that's, by the way, what Travis Kalanick is doing right now. That's his new
Live
firm.
Pigeons, yeah. Well, Alex, thank you so much for coming in. Julie, I know you're a big fan of the Walmart delivery.
Oh yeah, I couldn't live without it. But I also am a fan. So I was thinking about the evolution of taxi to Uber, Uber to Waymo, and I know you take taxis, and I don't when I'm traveling alone because I feel like an Uber is safer because there's like a record.
They know who it is.
Somebody can look and see what car I got and win all of that. And then Waymo takes it one step further because there's not a person who may be creepy driving it.
Yeah, you got to trust the computer. Always worried about hacking. That's the other thing that gets brought up. Well, thank you so much for joining us on FreightWaves today. We'll be back tomorrow. We have a great show tomorrow. We have the CEO of Geodis Americas, Laura Ritchie, coming to us from Nashville. That's on FreightWaves today.